When we first ran this model on our portfolio, the year one income went from like 0 or 2% to like 12 or 13% on that existing portfolio. And then the light bulb went off. One investor to another, I always invest on the GP side of the capital stack. The fund that we've created here is a GP fund. GP stands for general partner versus an LP fund, which is a limited partner, which is probably what you've experienced most up until now if you've invested in real estate. So what's the difference between the two? LP fund or limited partner fund is like when you invest in a syndication or a typical fund you invest in, you're a limited partner, so you have limited liability. You don't have to sign any notes for debt or take on any liability from the operator that you're investing with. But it does affect your returns and it affects your control over the project. In an LP situation, we're going to split the profits and the limited partners get a good return based on the money they've invested. But the general partners have only invested a little bit of money, so they've got skin in the game, but the return on their money because of the sweat equity is super high. Let me explain it. A typical build-to-rent community, let's say, is around $30 million. We've got one that we're building, it's 142 single-family detached homes, and the development cost is around $31 million. So we went and got a loan at the bank for $21 million, and that was a 65% loan to cost. That leaves us $10 million to put down of equity to develop this project. Well, in the $10 million, because of our track record that we have, we can go get institutional capital to partner or JV with us on that equity, and they'll actually put up 80 to 90% of the equity. So if we have to put up 10 million, they're putting 8 to 9 million, we'll put in 1 to 2 million. And that allows us to keep our leverage low on the debt, and now we're leveraging the equity. So with equity leverage, their money and our money is pari passu, it's equal, it's on the same footing. So we've actually de-risked this project by 80 to 90%. We get additional cash flows, more than just the return on our 10%. We may get 20 or 30%, in some cases 40 or 50%, depending on how we perform on that project. So you can see the general partner has the potential to get a lot more money because of their sweat equity, because of all the work that we do and the value that we're adding. And so the more experienced your team is, and we've got a very experienced team, and the better they are at what they do, that puts more equity and more value into the project, and we as the general partners cash in on most of that value. So in the Arabella Real Estate Fund, you're investing as a LP, meaning it's from a liability standpoint, but you're getting paid as a GP. Invest as an LP, get paid as a GP. Take a look at the fund presentation, get all the information. If this fits your investment objectives, we'd love to have you as part of our family of investors.